Hello and welcome to the next video in Chapter 3 of Accounting 205. Today, in this video, I would like to talk about transportation and travel expenses. Alright, so we're going to start on page 311 and we're going to work our way through to page 315. Alright, there is a difference between transportation and travel expenses. Transportation expenses generally occur while you are in town. Okay, so these would be expenses basically for, the use of your car and, and any other expenses that you incur while you are in the area. This could include things like parking. It could also include things like, getting toll expenses, maybe on the Indiana Toll Road, something like that. Okay, I would like to direct your attention to the top of page 3-12. Okay, at the top of page 3-12, okay, they talk about that the cost of transportation between the taxpayer's home and a work location is generally not deductible. Okay, that is known as commuting expense. So, if that's all you do is you drive from your home to work and back home again every day and you don't go anywhere else that's work related, then this is a moot issue and there wouldn't be any transportation expenses for you to deduct. However, let's take a look at the three exceptions at the top of page 312. Number one, a taxpayer is allowed to deduct daily transportation expenses incurred in going between the taxpayer's residence and work locations outside the metropolitan area. Okay, now again, that's a very loose term. Up here in northern Indiana, all right, just in case some of you are not from this area, all right, our metropolitan area up here could be considered to be, South Bend / Mishawaka, and maybe Elkhart, included. That's about 22 miles between all three cities combined. All right, so I get questions from clients that go, well, what if I drive to Kalamazoo? Well, Kalamazoo's in Michigan. It's about 60 to 70 miles from here, and most people would not consider that to be in the metropolitan area. Neither would Chicago, which is 90 miles to the west of us in Illinois. So, it's what your locale thinks is the metropolitan area. That's what would be important if you got audited. All right, let's look at number two. If the taxpayer has a regular place of business, daily expenses for transportation and temporary work locations are deductible. All right, so what they're saying here is let's say your home is in South Bend and you were told to, you had to go to Chicago for the day, and you're driving, you drive to Chicago and, you incur parking expenses in Chicago, and, maybe you had to, drive on the toll road or maybe over the Chicago Skyway. All of that would be deductible. All right, number three. The taxpayer may deduct daily expenses between the taxpayer home and another regular work location if the taxpayer's residence is the taxpayer's principal place of business. In other words, you're self-employed, all right, and you do most of your business out of your home. When you do that, all right, then virtually all of your mileage would be deductible, subject to any other limitations. Okay, they give you an example in the middle of page 12 about Walter, who's a self-employed CPA, and he also teaches at the local university. All right, if you read that very carefully, okay, he drives to his office, all right, every day, and then he drives to the university. All right, the distance from his home to his office is 12 miles. All right, that is commuting mileage and is not deductible. All right, the distance from his office to the university is 15 miles, and that is deductible. Okay, all right. The distance back home would not be deductible because that is a commuting mileage again. So generally the rule of thumb is this: the first trip out and the last trip back from your home and to your home generally is not deductible. Anything in between generally would be. Okay, now how do we know how to deduct it? Well, the first thing you would do is you would look at the standard mileage rate, all right, and that is 53.3 cents a mile in 2017, all right, and again it varies every year. Okay, how do you know you can use the standard mileage method? Well, the rules are at the bottom of page 3-12. All right, you either have to own or lease the automobile. You can't operate more than 5 at a time, which means you can't be a taxi service. All right, you can't claim depreciation on the vehicle more than straight line. All right, and as we'll see in Chapter 7, normally you would claim double declining balance depreciation on a taxable, on an asset in a tax return. Okay, so what I always tell my clients is this: is if you're trying to decide between standard mileage and using actual expense, look at your vehicle. All right, unless you're driving a 2017 Ford F-250 heavy duty that cost you $50,000, 90 times out of 100 you're going to be better off using standard mileage because it's simple. All you have to do is track your mileage. All right, that's it. All right, you need to know how many business miles you drove the car. You need to know how many total miles you drove your car in a year. All right, and a lot of times people are like, well, I don't know what the total miles were. And I just tell them, this is simple. Get yourself an oil change on New Year's Eve every year, because they have to record the odometer reading, and all you do then is you take the 2 receipts, you subtract the 2 odometer readings, and you know how many miles you drove the car. Take the number of business miles that you drove your car that year divided by the total miles, and you have the percent of business use. If you claim depreciation, you would not need the percent of business use for your for standard mileage, but you do need to know the total miles and the total standard miles that you would drive the car. So more times than not, you will need to use the standard mileage. Travel expenses. Travel expenses on page 314 and 315. All right, these are pretty straightforward. Okay, when you are traveling away from home, all right, you're going to Las Vegas for a convention, or you're going to, Orlando for a convention or something. Common sense says to make sure that you keep a record of the reason why you're going and all the expenses you incur, all right, while you are there. Most businesses will reimburse you for all of your expenses, so there probably won't be too big of a travel expense. All right, but just in case, make sure that you track all this. All right, one of the easy ways to get a travel expense deduction is to review the per diem rules on page 315. All right, per diem means that the government's just going to give you a flat amount every day to deduct. All right, like $250 a day, and that covers your lodging, that covers your meals, and it covers all your incidental expenses like parking and tolls and things like that. Okay, there are three of them available to you, and you would have to look these rates up at the IRS publications. They're not reprinted in your book. All right. A lot of self-employed people, though, have to use the third one, the meals and incidental expenses, and then they have to track their lodging separately. So if you are self-employed and you're going to file a Schedule C, the only one of the 3 that is available to you is the meals and incidental expenses listed on page 315. Okay, that concludes this video for transportation and travel expenses.